Hi, I'm Max Keiser. This is the Keiser Report. You know, Stacy, this is a momentous day for Keiser Report and Keiser Report on Espanol, on RT, on Espanol, winning the Silver Play Award on YouTube. It's a really fantastic achievement, and everyone down at RT Espanol Keiser Report headquarters is going crazy.
Right, we have the silver play button on our podcast on this episode of Keiser Report en Espanol. So that's a great achievement, and I'm so happy for our audience in Mexico, Spain, and the rest of Latin America. Mexico and Spain are the top two audiences.
It's all
watching.
about love. You know, we love you. You love us. Together we love, and we love some more. I love Stacy, okay? Let's be honest. Let's be honest about it, okay? That's the fact. That's what makes the magic happen.
Te amo. That's what we love you. I think I'm not saying it quite correctly, but we're learning Spanish. We'll come to Mexico and hang out with you. And
we want to be in one of those telenovelas with Max and Stacy down there in Mexico City. It's going to be us like Lucy and Desi Arnaz, but, you know, modern, up-to-date version.
That's right, delivering the financial news for you. I know you want us to get into the financial news now because that's why we're the number one. And this is from the New York Fed, John Williams. Okay, New York Fed is basically the central bank, right? The most powerful of the member central banks in America, part of the Federal Reserve System. He's finally, after 12 years of receiving this content here, he finally has come around to what the Keiser Report has told you over and over. And this applies to every country in the world that is printing money. Williams says there is some evidence that low interest rates can move up asset prices disproportionately held by wealthy households. We've talked about this. It's the Cantillon Effect.
He just described the Cantillon Effect, which we've talked about on this show many times. The money printing causes the wealth and income gaps. This guy down there at the New York Fed, he's just catching on to the facts of the situation. Now, kudos to him for not living in denial, for not following the crowd of mainstream economists who absolutely deny any connection between money printing, the Cantillon Effect, and why this small group of people happen to have been made billionaires in the last 3 years without actually doing anything other than clipping coupons supplied to them for free from the central bank. And while this group of people can't seem to get enough to feed their families over the course of a year. Why is that? He finally figured it out.
So to remind you, what happens is when the Fed basically gives free money to the banks that are supposed to lend it out, and they're getting the money for free with 0% interest rate or close to zero. And by the time it trickles down to the ordinary person, okay, perhaps they're getting 3.5% on their mortgage or 15% on a credit card if they have very high credit rating, or 20%, 30%, 40%. So that's what causes the Cantillon Effect, is the difference in the interest rate apartheid, as Max calls it. And I think it's interesting, too, that as soon as John Williams said this, that we saw a rout in the bond market, right? And we saw the 10-year yield spike, the 7-year, 5-year, like there was a huge turmoil in the bond market that was pretty unprecedented for the past few years anyway.
So the question is it by design or is it just by accident? And what we've been saying now for a number of years is that by design, the Cantillon Effect is not an accident, because when you fix the price of money by artificially keeping prices of interest low, underneath what the economy would suggest would be the normalized rate, you create this warping of the economic signals and of the underlying economy to the extent where all the marbles on, or, you know, the billiard balls on the billiard table seem to all roll into the same pockets, because the table is not balanced. It's tilted. It's like pinball, you know, tilt, tilt, tilt. But instead of that game ending, it goes on year after year after year. And the central bank has to get more absurdly over the top nutso in buying back now not only treasury bills and 3-year notes, but now they're going to be buying 10-year notes. They're probably going to be buying 20 and 30-year notes. And they've had to print 25% of all the money supply that's ever been printed has been done in the last 12 months, right? They're just money go brr, 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 brr. Why? To keep those few kleptocrats who run the bank. The banks are supposed to be distributing the money. That's their job. But instead, they hold on to it and say, we're just going to buy more houses for ourselves, and we don't care that we're not distributing it. You know, all these relief programs, they go to the banks first, and they don't distribute it. They hold on to it. How did Jamie Dimon become a billionaire? He didn't actually produce anything. He just keeps all the money that the government prints.
Right, because that's important to point out. So here, John Williams of the New York Fed, the most important Fed of all the member Feds of the United States Federal Reserve System, and he says that there's the low interest rates and the quantitative easing is what is causing these low interest rates, is causing a Cantillon effect, a wealth gap between those who have the assets and those who don't. What you're going to see a lot, you might see it on Twitter and stuff like that, is YCC, yield curve control. So they're trying to control all these interest rates at, you know, the overnight, the 1 year, the 2 year, 3 year, 5 year, out to all the way out to 30 years. In the case of Argentina, I guess they have 100-year bonds. But the fact is they're trying to control all these rates, right, to keep them from finding its free market rate. So because of what happened last week, what you're going to see, because of the huge rout, they call it, in the bond market, you're going to see them having to either cut rates. They probably don't want to cut rates yet until a full market crash, but they'll do more quantitative easing to try to drive these rates down, thus causing what he's already identified now as a problem, exacerbating the wealth and income gap.
Right. We've said that money printing causes asset prices to go up, and to the benefit of a very few people in society. And we get a lot of pushback from bankers and central bankers. We had this discussion with Danny Blanchflower. He used to be on the committee of the Bank of England for many times. He was kind of 1 foot in, 1 foot out. But a lot of professional economists will say, no, that's impossible. There's no connection whatsoever, even though it's obvious, it's clear in front of your face that this is exactly what's going on. But, you know, it's consolidating the global insurrection against banker occupation, because anybody who's upset about how the economy is being bifurcated to help the rich and destroy the poor even more is going to have a single point of attack, and that is the central bank. They know now the central bank is the center of the criminal racket that has destroyed their lives, you know. And I'm thinking about money go brrrr. I was thinking, translated into Spanish, it would be money go brrrr, ocho.
Ocho, 8?
Yeah, that's what I'm claiming that's a good translation. You know, you can argue with me, but that's my thought.
But you remember, we've talked about the bond vigilantes that used to exist, and then they got annihilated by basically the central banks, right? They've destroyed the ability to have a free and fair price signal, an honest price signal in bonds. So here's an interesting take, because the bond market, you know, is anywhere between 100 and 250 trillion. It's hard to, like, there's so many different numbers that come out. But here's what Cathie Wood, she's the founder and CEO of ARK Investments. She's one of the top investment advisors in America. She's very famous, Cathie Wood. And she's also a very, very early investor in Tesla and in Bitcoin. And she said, according to Dow Jones, DJ, Bitcoin may replace bonds. Cathie Wood says. This is a pretty remarkable statement coming from her.
Yeah, this is enormous, because you think about gold is worth about 10 trillion. Bitcoin is now hovering around 1 trillion. So it's hovering around 50,000 a coin. That means if it competes with gold, that would mean $500,000 a coin. Now, if it takes out the bond market, which is at 100 trillion, that's $5 million a coin and above. According to Michael Saylor of MicroStrategy, the entire global economy of roughly $400 trillion worth of tradable assets can be hyper-Bitcoinized. So the upside is really in the millions of dollars.
That is always going to be the problem, right? When you have 0% or negative interest rates on many government bonds, there's something like 18 trillion in government bonds that are negative. So if you have negative rates there, and the junk bond market, the junk bond rates are at their lowest ever. It's something like 3.5%. It's like ridiculous. They're not being paid for their risk. I could see why, if the Fed and the central banks want to force prices, interest rates below where they are, in order for the governments to be able to continue borrowing at cheap rates and afford, well, because they can never afford to pay more interest rates, right? They have all these massive debts now that they would literally go bankrupt if rates were ever to go up higher. So there could be no free market rate there. And investors are starting to clock that, right? They're starting to figure that out and saying, well, they can't control Bitcoin. They can't control the price of Bitcoin as a price signal of us like understanding what's going on in the market.
Absolutely right. And so it could potentially replace the bond market as the collateral of the global economy.
Yes.
Right? It doesn't mean that because Bitcoin is not like a bond in a fractional reserve system where you can create layers and layers of debt to supposedly create GDP. That is still possible with Bitcoin. You can still structure it into debt instruments, but because the underlying collateral in this case being Bitcoin and the private keys are owned by essentially the outsiders of the system, have a check on Wall Street. Never again will Wall Street be able to infinitely rehypothecate as they do in England, where they can sell the same bond 1,000, 2,000, 3,000 times. That's what infinite rehypothecation means. You can sell the same bond an infinite number of times because nobody is doing an audit of the original foundation bond that you are using as collateral to sell the infinite bonds. But if that's Bitcoin and you remove it from the system, then you can no longer infinitely rehypothecate, and that restores economic justice to billions of people around the world, and it's happening with Bitcoin.
Yeah, and here's a final headline regarding this government debt that they're trying to control, this YCC yield curve control to sustain, is governments in advanced economies borrowed $18 trillion from bond markets, according to Wall Street Journal, more than ever before during the first year of the pandemic. $18 trillion. Who knows what's going to happen this year if any of these variants happen or stock markets crash. Remember when the stock markets crashed in 2008? There was that was the first of the beginning of these unprecedented amounts of government borrowing. So yeah, we're in a precarious situation, I would think. But now the Fed is finally admitting what Keiser Report has told you for the past 12 years, and that's why we are now award-winning content creators officially.
That's awesome. You know, it's about time. Thank you, RT Espanol, Keiser Report team. Once again, number one, we're going to take a break. And when we come back, much more coming your way.
That was a bad segue. We just lost our perch at number one.
Welcome back to the Keiser Report. Time now to go to Stephen Flood of goldcore.com. Stephen Flood, welcome.
Hey, Max, great to be here.
So I suppose the biggest news of the past week is the dramatic rise in yields. Your thoughts on this? Will money printing have to accelerate? How will this impact precious metals, Stephen?
The market generally is getting concerned about inflation. I think they're looking at the Fed and the signals coming from the Fed, thinking that they're not taking it as seriously as the market wants them to. And they're getting ahead of that kind of trend. So yields are rising, prices in bonds are falling, people are moving out of that market. And then you look one step ahead and you think, well, does the equity market look expensive in that kind of scenario? There's a thing called the equity risk premium, which is like the percentage that you should get in over bond yields to justify a stock market position. And if yields are rising, that equity risk premium, contracts, and suddenly the equity markets look a little bit toppy. So they're kind of reacting as well to this news on a kind of like a second order basis. Overall, though, what you're seeing is that, inflation is in the offing and people are worried about it. What's going to happen when we come out of COVID and people start spending all that money that they've saved up? What happens to the economy? Does it overheat? Do the powers that be, are they able to keep control of it? So yeah, initially, I think what you find is that there's a bit of a sell-off. A lot of things get liquidated, and we've seen that before when events start to take a mind of their own. So gold and silver tend to sell off with equity markets in initial stages of a potential crisis, and then they tend to, as money rotates out of risk on, which is equities and certain bonds, into risk off, which is cash and safety and metals, then those things should actually start to right themselves and gold and silver will start to rise again. Typically, that's what happens.
Gold trading at an 8-month low. Looks pretty pokey. What's going on?
It's incredible. I mean, I think what you're seeing is there's a tale of two markets here. There's the paper price of gold, and then there's the actual physical market for gold investment product. And the investment market is made up of the spot market price plus the premiums, and premiums have started to rise. In fact, in silver they've risen quite a bit. In gold they're beginning to rise as well. And I think that's going to happen a lot more as investors turn to physical gold and they look to allocate maybe kilo bars or to buy bullion coins. And you're going to find those things become quite difficult to get your hands on if this sustains. So I mean, we're seeing huge demand for precious metals at the moment across all the markets, and we think that's going to continue.
Of course, the Wall Street Bets crowd and Reddit, they made a splash a couple of weeks ago with their short squeeze on a thinly traded stock, GameStop. And then the momentum kind of shifted over to, hey, let's squeeze silver, because the dynamics are similar. There's a huge overhanging, as you call it, paper silver market, which are primarily short sales to keep the price of silver and gold down from actually having any real price discovery. What if there is a serious squeeze silver campaign out there? Would it have an impact?
Absolutely, yeah, no doubt. I mean, the jury's out in terms of the capacity of the market to be squeezed fully. There's a lot of silver, but it's not in the right place. It's not in the right format for certain vehicles. So the ETF might come under pressure. It may not be able to fill its baskets. You might have its price might decouple from the silver price, and it could become disorderly. But there's we're finding good supply at the refinery level. For 1,000-ounce silver bars in Zurich, we have a fair amount of stock there, and we have a fair amount of a line of sight to the refiners and their stocks as well. It's not quite there yet, but it's silver is very much a marginal investment. Most people haven't a clue about it until recently. That is, it wasn't on anyone's radar. I do think, though, that as this inflation story begins to take off, and I think there's a tsunami of inflation coming, and I think people will look to alternates, and silver is definitely going to catch a bid, and you're going to see a lot of people looking to allocate that into their portfolio for the first time ever. And so this could actually develop into a real full-on silver short squeeze.
A tsunami of money printing. To give some numbers here, 25% increase in money supply just in the past few months, actually. If you look at M1, M2, these numbers and charts are gone hyperbolic on the upside. The policymakers in Washington and the op-ed opinion makers in the world's top newspapers tell us that nothing should be worried about here. Why should we be worried?
Keep calm, move along. It's quite frightening what's happening generally and globally, led by the Fed and the ECB in Europe and the Bank of England. Essentially, when they print money in order to prop up these capital markets, namely the equity markets, the bond market, and even junk bond markets, what they're essentially doing is printing money, and they're taxing the savings that people have again. So you're paying tax after tax, and that is, I think that's absolutely criminal. And people don't realize that this is actually devaluing their savings after tax. These people are not elected. They don't have tax raising authority per se, but what they do by virtue of printing money is actually a tax. So you have to kind of, what we use in Goldcore is we talk about personal sovereignty. So having a form of financial instruments that can give you personal sovereignty, that's the role of gold and silver in your portfolio, and it works best when it's diversified. So if you do find yourself in kind of scary territory where things are gapping down, and we all know what happens when a market sells off in a big way, you're not able to sell. It just gaps down, multiple percentages at a time. Gold and silver should rise and take the correction out of that sting, and calm minds, and that's really its proper role. So that's why many of our customers buy precious metals.
I often point out the fact that people malign gold, but it has made new all-time highs in every major currency in the world recently, and has been performing for 10 or 15 years in that capacity. So it does kind of what it's supposed to do. Now, Stan Druckenmiller recently said he's very, very short the dollar due to the increase in the money supply. He owns both gold and Bitcoin. And so this is a play now in the institutional level. Stan Druckenmiller never had a down year since 1981. He's equating gold and Bitcoin, as many other managers are doing now. This, of course, in the gold community is considered heresy by many. Where do you stand?
I've studied Bitcoin for a long time, and I know you're a huge proponent of Bitcoin. And I think that for me, the jury's still out, but I think a lot of people have looked at it as being an alternate to currency. And because it's decentralized, it's not controlled by a government, it gives added protection. And I think there's no doubt about that. But I do think that there's a huge amount of people who are looking at it right now, and they're going into it on the basis of price rise alone, and not for other fundamental reasons, not to use it as a currency. And so I look at Bitcoin as being a great experiment in blockchain technology, which I absolutely believe is transformative for the global economy going forward and for information technology. And if you overlay artificial intelligence onto blockchain technology, you have probably a very deflationary factor in future economies, but you have huge fundamental benefits as well. So I do understand why people look at gold and blockchain the same way. I do think gold is far superior. It's performed around 10% per annum annualized for the last 20 years. It's outperformed almost every other market out there by a handsome margin. And it's for something that's inanimate and it just sits there and it doesn't actually have a yield in its own right, I think that tells an awful lot about the stewardship of the global economy and the actions of the central bankers.
Of course, we're talking about Bitcoin and not blockchain. Yeah. Blockchain is just part of the tech stack of Bitcoin. BlackRock recently said their own clients are moving from gold to Bitcoin. They see it as a substitute for gold. And now here's where it gets interesting in the gold mining industry. Franco-Nevada said in their earnings report that the price of gold fell from August because of Bitcoin. So they're citing that in their report at a major gold miner as being a fundamental issue and something that would go under the category of risk for them as a gold company because the market sees Bitcoin, beyond anyone's individual opinion, the market, Mr. Market, says Bitcoin is equivalent or better than gold as an inflation hedge. As Paul Tudor Jones has said, it's the fastest horse in the race. Is this a public relations problem for the gold mining industry? They don't seem to be able to get their message through.
I can understand it. And if all you know is gold mining and gold production and that's it, and then suddenly this new player on the block comes along and steals your luster, I can understand that reaction. Definitely gold has lost ground to Bitcoin in the inflation credential area, absolutely. But Bitcoin is very untested. I mean, it hasn't had any major market cycle really yet. Hasn't been tested. It's not widely known, widely used. It has a number of fundamental problems to it that can be replaced by other better versions. I wrote an article recently comparing Bitcoin to the Model T. It was a fantastic technology at the time. It was eventually overtaken by other better, faster rivals. And I do think the Bitcoin has a story to tell, but I think over time it might find the competition heating up quite a lot as blockchain becomes much more the story than Bitcoin is today. But that being said, gold has an enormous history behind it and has long market cycles of data to support its position. I don't think it's going to go away at all. In fact, I think what Bitcoin has done, it's done gold a favor because it's opened people's eyes to the abuse, the massive market abuse of our monetary systems, and people are looking at alternatives. And so I think that commentary will eventually come around in gold's favor. We're not seeing it on the trading desk here at all. There's an awful lot of demand for gold, and I think people are looking at these price points right now and thinking it's the buy of the century.
I do think that Bitcoin's going to help gold as gold becomes something of the poor man's Bitcoin. There have been hundreds of attempts to knock Bitcoin off from the lead, and they've all failed. That's why it's worth $1 trillion, and looks like it's going to head to $10 trillion. But nevertheless, gold is still a go-to asset. I don't believe that gold's going to be completely demonetized, as some people believe. But you do have to be in business over there. How do you market gold to the millennial generation right now that seems to be all in on Bitcoin and look at gold like that Model T that you just described?
Well, they're not actually all in on Bitcoin. They're very much all in on stocks, and they're in on tech stocks. And a lot of people look at tech stocks and Bitcoin as being very much in the same vicinity. So I do think that I was talking to a millennial the other day, and he was showing me his phone, and he was showing me these stocks, and they were going up 20, 30% a day, and he was up a lot. And he loves talking about stocks, but he's never seen a full market cycle. And I explained to him, I said, have you ever heard of the concept of a gap down? And he hadn't. And I was like, okay, well, this is what happens. You go to bed at night, your portfolio's at 100. You wake up in the morning, it's at 2. and that is the price. And that's what happened. Essentially in the Nasdaq stock market bubble, where there's a huge amount of euphoria for metals for stocks. So I do think Bitcoin is catching a bid. Bitcoin is also catching a bid from the money printing. You talked about the M1, M2. That's a huge driver for it. Also, there's a malaise. People are bored. They're at home. They're not doing anything. They're on their phones. They're looking at stuff. So you have a fad thing going on there too. But I do think the big story is it's an alternate currency. It's decentralized. It's a fantastic example of blockchain. And I do think you're going to find better blockchains versions coming out. That's just my own view. And I know you're very passionate about it. But I'd actually start looking east, and I would look at the Chinese government. I'd look at the Chinese central bank, and I wonder if they're going to come out with a cryptocurrency that's globally defined, based on gold, based on other special drawing rights and other basket currencies, and make a play for that reserve currency status as the dollar is weak. And I do think that's actually probably the big story that's going to come out in the next 2 to 3 years.
Stephen Flood of our friends over there at goldcore.com, the Bitcoin gold story. Much more to come. We can discuss this, I'm sure, in the future a few times. Stephen, thanks for being on Keiser Report.
Thank you so much. Great to be here.
And that's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Stephen Flood of goldcore.com. Until next time, bye, y'all.